Have you ever really wondered what makes the global energy market tick? I'm not talking about the headlines. I mean the real machinery humming away underneath it all. Well, we're going to dive right into that. Today, we're literally following the molecule on its journey, from deep inside the Earth all the way to the road, to figure out what the industry's vital signs really are.
Okay, just picture this for a second. You're a big shot executive at a huge utility company. You make just one, bad bet. You misread a single signal, and bam, by lunch, your company is out for $40 million. And listen, this isn't some made-up story. That's a direct quote from a guy who actually lived through it. I mean, the stakes just don't get much higher than that.
So, that's the big mystery we're unpacking here. How on earth can a single number, a piece of data that comes out at the exact same time every single week, have the power to cause that much financial chaos in just a matter of minutes? To figure that out, we've got to go back to that very, very expensive Thursday. Right. So our story really kicks off here, with what looks like a totally boring government report. But for traders, this thing lands like an absolute bomb every single week.
And this is it. This is the report. It's not some complex 50-page analysis. It's just one number. How much natural gas got put into storage or taken out of storage in the last 7 days? It sounds almost ridiculously simple, doesn't it? But as you're about to see, its impact is anything but.
The crazy part is just how fast this all happens. Look at this. At 10:29 in the morning, everything's cool, markets are calm. 1 minute later, the report drops. And the news isn't good. Storage is way lower than it should be. All of a sudden, those forecasts for cold winter seem terrifying. And by 10:45, just 15 minutes later, the price has shot up 10%. That's the raw power of this number. And to really get why, we need to zoom out and look at the whole system.
You have to understand, the energy industry isn't just one giant business. It's more like three totally different businesses stacked on top of each other, kind of like Lego blocks. And if they don't click together just right, the whole thing can fall apart.
So, think of this as our roadmap. It's pretty simple, right? Upstream, they're the ones getting it out of the ground. Midstream takes that raw stuff and moves it all over the place. And then you've got downstream. They're the ones turning it into gasoline, jet fuel, plastics, you name it. They make their money on something called the crack spread, basically the gap between what they pay for crude and what they can sell the refined stuff for. But, and this is key, the real drama, the source of that $40 million Thursday is all about how those first two, upstream and midstream, have to work together. So, let's follow the money. How does it actually flow through this giant machine? Well, each of these sectors has a completely different way of making a buck. And getting that difference is the key to understanding, well, everything. This chart just lays it out perfectly. Upstream companies are the prospectors, the wildcatters. Their whole business is one big bet on the price of oil and gas. It's high risk, but if they're right, it's incredibly high reward. Now, midstream companies, they're the toll collectors on the highway. They couldn't care less about the price of the stuff in the trucks. They just charge a fee for every molecule that passes through their pipelines. Slow, steady, predictable. Two totally different worlds. And for upstream, this is what it all boils down to. Look at these two companies. On the surface, they look identical, both bringing in $2 billion from their operations. But look closer. Company A spends less than that on new wells, and they're left with $500 million in pure cash. Company B? They have to spend more than they make just to stand still. They are on a treadmill to nowhere, just burning through cash. One is a great business, the other is a disaster waiting to happen.
And it gets even trickier. When an upstream company boasts about its proven reserves, you have to ask, okay, but what kind of reserves? Proved developed, or PD, means oil is flowing today. That's cash in the bank. But proved undeveloped, PUD, that's just an IOU. It means, yeah, the oil is probably there, but you got to spend a ton of money to actually go get it. And here's why that matters. When prices crashed back in 2014, the companies built on PD reserves made it through. The companies loaded with PUDs, they got absolutely destroyed because it no longer made financial sense to drill.
All right, let's switch gears to midstream. Their business model is, frankly, kind of boring, but in the most brilliant way possible. They sidestep all that crazy price risk by just owning the infrastructure. They're a logistics business, plain and simple. They don't care if oil is $50 or $100 a barrel. They get paid to move it, period.
So the quality of a midstream company really comes down to one thing. Its contracts. The absolute gold standard is something called take or pay.
This means customers have to pay for their reserve space in a pipeline whether they use it or not. It creates these incredibly stable, predictable cash flows, almost like a utility company. On the other end, the worst kind is commodity-linked, which means you're basically taking on all the price risk of an upstream company but with none of the potential upside.
This quote just says it all about the power of midstream. Back in 2018, drillers in West Texas were pumping out so much oil that they literally filled up all the pipelines. The result? The exact same barrel of oil was worth $15 less there than it was just 400 miles away in Houston. You can have all the oil in the world, but if you can't move it, what's it worth? The pipelines, the midstream assets, held all the cards.
Okay, so we've got the blueprint of the machine. We know how it's built. Now let's get back to our mystery from the beginning. It's time to learn how to read the industry's live dashboard, the signals that tell us exactly what's happening right now.
First up, this number, 548. This is the Baker Hughes rig count, and believe it or not, it's one of the single most watched numbers in the entire industry.
So why does one number matter so much? Because rigs don't lie. The rig count is a direct signal of what companies are doing with their money, not just what they're saying in a press release. If that number is going up, it means companies are spending money, they're drilling, and they're confident about the future. It's our best leading indicator for what oil and gas supply is going to look like 6 to 12 months from now.
And that brings us right back here, to the number that kicked this whole thing off. 3,579 billion cubic feet of natural gas sitting in storage.
And there it is. That's it. That's the answer to our $40 million question. See, natural gas demand is super seasonal, right? Everybody cranks up the heat in the winter. So storage, that's the buffer. It's like the country's giant pantry. And if that pantry is looking a little empty right before winter hits, the market freaks out. It knows there's zero cushion. One bad cold snap could mean shortages. The fear of literally running out is so intense that prices just go through the roof. And that, right there, is exactly what happened on that ridiculously expensive Thursday.
Whew, okay, we've gone from the wellhead to the pipeline to the power plant. We've covered a lot of ground. So let's boil it all down and focus on the handful of signals that cut through the noise and actually matter.
Look, if you want to build your own dashboard for this industry, this is it. These are the 5 numbers you need. The rig count tells you about future supply. Storage and inventory numbers give you a perfect snapshot of the supply-demand balance today. And the prices for crude and natural gas, that's the market's real-time mood ring. Honestly, with just these 5 data points, you know most of what you need to know.
Which really brings us to the final and maybe the most important question of all. You can understand how the whole system works, you can even find the best assets in the world. But what is it that turns a good asset into a good investment?
And at the end of the day, it's this. The technicals, the hard data about rig counts, cash flow, storage levels, they don't have an agenda. They don't lie. They cut right through the slick investor presentations and the breathless headlines. They tell you what is actually happening on the ground in the real world, right now. And understanding these signals, well, that's the key to seeing the industry not for what people say it is, but for what it truly is.